If you've ever heard about the internal rate of return, or IRR for short, and thought, that sounds complicated, don't worry, we've got you covered. Welcome back to the Industry Portal's Finance Explainer series, where learning finance is made simple. By the end of this video, you'll know exactly what IRR is, how it works, and why it's one of the most powerful tools for evaluating investments. So let's dive in. So what is the internal rate of return? Simply put, IRR is the rate of return that makes the net present value, or NPV, of an investment equal to zero. In other words, it's the percentage rate at which the money you put into an investment equals the money you get back, adjusted for time. If NPV is a new term, check out the video on NPV for a simple explanation. So think of it like this. IRR tells you the annual growth rate of an investment. If you're comparing projects, the one with the higher IRR is generally the better choice because it gives you a higher rate of return on your money. Let me explain this with a simple example. Imagine you're deciding whether to invest £1,000 in a project today. The project is expected to generate the following cash flows. In year one, £500, and in year two, £600. Now, the internal rate of return is the interest rate at which the sum of these future cash flows equals your initial investment of £1,000. At the IRR, you're breaking even in terms of the time value of money. So the formula for IRR looks like this. 0 equals cash flow in year one divided by 1 plus IRR to the power of 1 plus cash flow in year two divided by 1 plus the IRR to the power of 2. And then you minus the initial investment. Now, if you've already checked out the NPV video, you may be thinking, this looks very familiar. And I'm aware some of you may be thinking this looks complicated, but don't worry. Most of the time we use financial calculators, Excel, or tools like Google Sheets to calculate IRR automatically. You don't need to do this by hand unless you really love maths or are forced to in an exam. Here's what's important to understand. If the IRR is greater than the cost of capital, like the interest rate on a loan or the rate you could earn elsewhere, the investment adds value. If the IRR is lower, then it's probably not worth it. Now, here's a real-world example. Let's say you have two investment opportunities. Project A has an IRR of 8% and Project B has an IRR of 12%. If your cost of capital, like your loan interest rate or expected return elsewhere, is 5%, both projects add value. But since Project B has a higher IRR of 12%, it's the better choice because it gives you a higher return for your money. Now let's talk about why IRR matters. Firstly, it helps compare projects. If you have multiple investment options, IRR gives you a clear, percentage-based way to decide which project will deliver the highest return. Secondly, it works for businesses and individuals. Whether you're evaluating a new factory, a real estate purchase, or even starting your own side hustle, IRR helps you figure out if the project makes financial sense. And thirdly, it factors in the time value of money. So like NPV, IRR accounts for the fact that money today is worth more than money in the future. Now here's a quick tip for you. While a higher IRR usually means a better investment, don't rely on IRR alone. Always look at the actual cash flows, risks, and other factors before making a final decision. Sometimes, projects with extremely high IRRs can come with higher risk or unrealistic assumptions, so it's better to be safe than sorry. Okay, so let's recap. IRR is the interest rate that makes the NPV of an investment equal to 0. A higher IRR means a higher potential return, which is great when comparing projects. If IRR is greater than your cost of capital, the investment adds value. And that's it. Internal rate of return explained simply. If you're yet to check out the other explainers on the time value of money and NPV, be sure to check out those to complete the picture. And hey, if you found this video helpful, don't forget to like, subscribe, and hit that bell icon for more videos just like this one. If you're keen to learn more about finance, be sure to check out the industryportal.com, link in the description below. Thanks so much for stopping by, and as always, keep growing, keep learning, and I'll see you in the next video.